Hi. Very often, I do not have time to carefully read a paper, but I would like to see it presented by its author. If you feel the same about one of my papers, then this video may be for you. So in this video, I'm going to present my paper on the trilemma for low interest rate macroeconomics. The motivation for that work, as well as for much of my research over the past few years, is the Japanese situation over the past 3 decades. So since the mid-1990s, the Japanese economy has had a zero nominal interest rate constrained by the zero-lower bound, with a binding zero-lower bound. Inflation has been around 0% on average over the past 30 years, sometimes slightly positive, sometimes slightly negative, but about 0% on average. And GDP growth has been rather weak. Now, this is despite not expansionary, but super expansionary monetary and fiscal policy. The money supply has been multiplied more than tenfold to 100% of GDP. Now, you would expect this to create inflation, but it has not created any inflation. And public debt is about 260% of GDP. So you would expect long-term interest rates to be high. But in fact, in Japan, long-term interest rate, short-term interest rate, all interest rates are very low and very close to 0%. Now, this is a very paradoxical situation. And my favorite explanation for it is the secular stagnation hypothesis. It is the idea that the economy fails to produce at full capacity due to a lack of demand, and that this is a permanent state of affairs. Now, the Eurozone has been walking in the footsteps of Japan from the Great Recession of 2008 until the COVID pandemic. The Eurozone economy was in a very similar situation. Aggregate demand in the Eurozone appears to be rather depressed. And in fact, we cannot rule out the possibility that we're going to go back to secular stagnation. Now, the US economy has had higher inflation and higher growth, but this is somewhat related to the trilemma I'm going to talk about. Now, whenever you write a careful model of secular stagnation, you realize that you have multiple equilibria. You have a Keynesian secular stagnation equilibrium, a Japanese equilibrium, which is jointly characterized by a binding zero-lower bound nominal interest rate, by low inflation, and by underemployment, by a negative output gap. Now, you also have a neoclassical equilibrium characterized by full employment and a very low natural real interest rate. When demand is very depressed, if you want to have full employment, the real interest rate needs to be sufficiently low in order to induce households to spend rather than save. So you may need the real interest rate to be -2, -3, -4%, something like this, a very negative real interest rate, natural real interest rate. Now, as a result, you need inflation to be sufficiently high for the zero-lower bound to be non-binding. Finally, there is a possibility of having a Ponzi equilibrium characterized by full employment, low inflation, and a Ponzi scheme. Now, whenever you do macroeconomic policy, there are at least 3 desirable objectives. First, you want to have full employment. Second, you'd like to have low inflation, typically inflation being on target. So if central banks have a 2% inflation target, they would like inflation to be equal to 2%. And you would like to have no Ponzi scheme. Now, the common wisdom in macroeconomics is that the best way to get full employment over the long term is precisely to have low inflation and no Ponzi scheme. But in fact, in this paper, I'm going to argue that when the natural real interest rate is very depressed, when aggregate demand is very depressed, these 3 objectives are inconsistent. You can only have 2 of the 3 policy objectives being met. If you're in the secular stagnation equilibrium, then you have no Ponzi scheme, you have low inflation, but you have a negative output gap, so you fail to have full employment. If you're in the neoclassical steady state, then you can have full employment and no Ponzi scheme, but then you need to have a little bit of inflation. Inflation needs to be sufficiently high for the zero-lower bound to be non-binding. So if the natural interest rate is -3, -4%, you need at least 3 or 4% inflation, which may be above the target of the central bank. The third possibility is to have a Ponzi scheme, in which case you can have both full employment and low inflation, but then you need to have a Ponzi scheme. Now, what is the intuition for it? Well, if you want to have full employment, you either need to have a very low real interest rate, which requires a little bit of inflation to prevent the zero-lower bound from binding, or you need to have a Ponzi scheme that creates a wealth effect that makes households feel wealthier and that induces them to spend more. This is like a Pigou effect, if you want. Now, what is the downside from having a Ponzi scheme? Well, the downside from having a Ponzi scheme is that it can collapse. It can be that at any point in time, households want to run away from the Ponzi scheme, in which case you're going to have an upward jump in the price level and you're going to have high inflation. Now, what I'm going to argue in this paper is that depending on the parameters of the economy, each of the three possibilities can be the optimal policy, resulting in a non-trivial policy trilemma. So let me start by presenting my model of cyclical stagnation. I'm going to present a streamlined version and focusing on the government budget constraint because that's where the action is as far as the Ponzi scheme is concerned. So let me start with the government's flow of funds constraint. So the government has public debt B. So B is like nominal debt. So B dot is the increase in government debt. Well, that's equal to the interest payment, the nominal interest payment on the outstanding stock of debt, net of tax revenue, fiscal revenue. So tau is real tax per capita, P is the price level, and N is the population size. Now, before defining the Ponzi scheme, the magnitude of the Ponzi scheme, I need to define the present value of real primary surpluses, and it's given by this expression, psi, and that's basically the present value of future taxes, where gamma is the stochastic discount factor. Now, I'm going to focus on real variables in the model, so I need to define real debt per capita, well, that's nominal debt divided by the price level and divided by population size. Now, finally, I can define a Ponzi scheme. A Ponzi scheme delta is defined as the gap between real government liabilities and the present value of government surpluses. Now, if government liabilities, government debt are fully backed by future surpluses, then in that case, you have no Ponzi scheme. But if government liabilities are higher than the present value of real primary surpluses, then in that case, you do have a Ponzi scheme. Now, what is the downside from having a Ponzi scheme? Well, it can collapse. How does it collapse? It can collapse through an upward jump in the price level. So whenever you have a Ponzi scheme, you can have an upward jump in the price level that reduces the magnitude of the Ponzi scheme to 0. So let me be more specific about this by specifying the stochastic process for the price level. So I'm going to assume that the Ponzi scheme collapses at Poisson rate epsilon. So if the Ponzi scheme does not collapse, then the price level just increases at the inflation rate pi, but with probability epsilon dt at each point in time. So at rate epsilon, it's a continuous time stochastic process, at rate epsilon, the price level makes an upward jump of this magnitude, delta of epsilon. And this magnitude of the upward jump in the price level is precisely what is required in order to reduce the magnitude of the Ponzi scheme to 0. So basically, whenever the Poisson shock realizes, that's when the fiscal theory of the price level reappears and prevents the Ponzi scheme from existing. Now, the shock, the epsilon shock, could be a sunspot shock. Suddenly, households wake up and don't believe in the sustainability of the Ponzi scheme anymore, or it could be a fundamental shock to the economy that raises the natural interest rate and that makes the Ponzi scheme no longer sustainable. Now, the rest of the model is quite simple. It's basically a Ramsey model, a neoclassical growth model, but for simplicity, I don't have productivity growth and I don't have capital. There are three non-standard features in this model. So first one is the preference for wealth. So I'm assuming that households have a preference for wealth, a derived utility from the ownership of wealth. So AT is household wealth, but in fact, I'm going to assume that households do not have a preference for wealth. They have a preference for net wealth. Wealth net of the present value of future taxes. And the present value of future taxes is precisely equal to minus B plus delta. Now, why am I assuming a preference for net wealth? Well, just to have a Ricardian household, so to make sure the Ricardian equivalence does hold, it makes the model more neat, and I think it's also quite more plausible. Finally, a household also have a disutility from nominal instability. So whenever there's a change in the price level, that reduces the welfare of household. Now, the second feature of this economy is that it's a monetary economy, and therefore there's a nominal interest rate and there's a zero lower bound on the nominal interest rate. And finally, well, prices are perfectly flexible, wages are flexible as well, except for downward nominal wage rigidity. I'm going to assume that nominal wages cannot fall below pi r. So pi r is a minimum rate of nominal wage growth. And this leads to this complementary slackness condition that either inflation is above pi r, in which case the downward nominal wage rigidity constraint is not binding, and so firms' demand for labor is equal to household supply of labor, which has been normalized to 1, or if you have, conversely, if you have underemployment, if labor demand is below labor supply, this must mean that the downward nominal wage rigidity constraint is binding, in which case inflation is equal to pi r. I should emphasize that on the production side, I'm going to make things as simple as possible, assuming that 1 unit of labor can produce 1 unit of consumption. So wage inflation is the same thing as price inflation in this model. Now, if I put everything together, I can write a set of equations that fully characterize the equilibrium of the economy, at least the equilibrium of the economy until the Ponzi scheme disappears, collapses. So the first equation is by far the most important. It's the consumption Euler equation. It's the aggregate demand block of the economy. Now, in the standard New Keynesian model, you would only have these first two terms as a standard, dynamic AS equation or consumption Euler equation. Now, what's important is that because there's a preference for wealth, there's a new term, which is a ratio of the marginal utility of wealth over the marginal utility of consumption. And there are two things to be noted about it. First, the preference for wealth makes household more patient. You can see that the preference for wealth is the same thing as a smaller discount rate, and that makes household more patient, more willing to save. That's going to depress demand. But the other thing to notice is that in equilibrium, when the asset market clears, net wealth of the household is just equal to the Ponzi scheme. If we had capital, it would be K plus delta, but we don't have capital, so net wealth in equilibrium has to be equal to the magnitude of the Ponzi scheme. And so you can see that if the Ponzi scheme is larger, then households feel wealthier. That's going to reduce the marginal utility of wealth, and that's going to stimulate aggregate demand. There's also a term, a risk adjustment term, because when the Ponzi scheme collapses, there could be a jump in consumption from C to C bar, and so there's an adjustment, but that's not really important. The second equation is a downward nominal wage rigidity constraint, where I've replaced labor by consumption, because 1 unit of labor produces a unit of consumption. The third equation is a risk premium equation, not very important either. So basically, it says that the real return on bonds has to be larger than the real return on the risk-free asset. Why? Because nominal bonds are risky, because you can have an upward jump in the price level when the Ponzi scheme collapses. The fourth equation is a Taylor rule, the Taylor rule subject to the zero-lower bound. And the fifth equation is really important. That's the dynamics of the Ponzi scheme. So you should think of a Ponzi scheme as a rational bubble. Well, a rational bubble must yield the same return as any other asset. So the return from a rational bubble has to be equal to R. Now, in a growing economy, the return relative to the size of the economy is R minus N, where N is the population growth rate. But here it's a stochastic bubble because the Ponzi scheme can collapse. And so we must compensate the possibility of collapse of the Ponzi scheme by a higher growth rate so that households are happy to hold Ponzi debt. And finally, there's a transversality condition. Now, what's important to realize from this set of equations is that when we look at the downward nominal wage rigidity constraints, there are two possibilities. Either it's binding or it's not binding. When we look at the dynamics of the Ponzi scheme in steady state, when delta dot is equal to 0, well, there are two possibilities. Either we have no Ponzi scheme, or we do have a Ponzi scheme, in which case this pins down the interest rate, the equilibrium interest rate. Well, this gives 4 steady-state equilibrium possibilities, one of which only exists under rather stringent conditions, so I only discussed it in the appendix to the paper, so we're left with essentially 3 steady-state equilibrium possibilities. So the first equilibrium possibility is to have a non-binding downward nominal wage rigidity constraint and no Ponzi scheme. That's a neoclassical steady state. So you have full employment, you have no Ponzi scheme, and you have a real interest rate that is very depressed. Now, how can we know this real interest rate? Well, from the consumption Euler equation. So when there's no Ponzi steady state, well, there's no Ponzi scheme, then this term disappears because the Ponzi scheme cannot collapse. It does not exist. And delta is equal to 0. And so you can deduce the real interest rate that is necessary for aggregate demand to be equal to 1. Okay? And so that gives you the expression for the natural real interest rate. The second possibility is to have a binding downward nominal wage rigidity constraint together with the absence of a Ponzi scheme. That's the secular stagnation steady state. So in that case, you have a binding downward nominal wage rigidity constraint, so that pins down the inflation rate to be equal to pi r, from the Taylor rule that implies that the nominal interest rate is equal to the zero lower bound, and there is no Ponzi scheme. And so from this, you can actually determine the level of output, which is demand determined. And so the real interest rate is just minus pi r. And with no Ponzi scheme and a real interest rate of minus pi r, what is the level of demand? You can deduct it from, you can deduce it from the consumption Euler equation. Finally, we have the Ponzi steady state where you have a non-binding downward nominal wage rigidity constraint together with a Ponzi scheme. And so you have full employment. The real interest rate is determined by the dynamics of the Ponzi scheme. And finally, the magnitude of the Ponzi scheme is given by the Euler equation. That's basically the magnitude of the Ponzi scheme in order to ensure that aggregate demand is equal to 1, despite the real interest rate being equal to this, which is typically an excessively large number. So the real interest rate is higher than the natural interest rate, so somewhere the real interest rate is too high. Well, this is a magnitude of the Ponzi scheme that you need in order to stimulate aggregate demand sufficiently to have full employment at this real interest rate. Okay, now there are existence conditions for each of these steady-state equilibrium possibilities. So for the secular stagnation steady state, you basically need aggregate demand to be very depressed, which means that the natural real interest rate has to be smaller than the real interest rate of the secular stagnation equilibrium. For the neoclassical steady state to exist, you need the inflation target pi star to be sufficiently high for the zero lower bound to be non-binding. So if the natural real interest rate is -3, -4%, you need at least 3 or 4% inflation. And for the Ponzi steady state to exist, well, you need the natural interest rate to be depressed. That's typically the same as the existence condition for a rational bubble. And there's also a mild condition on inflation. Now, before moving to the trilemma, I just cannot resist the temptation to make a small digression to emphasize the nature of my secular stagnation equilibrium. So in the next 2 slides, I'm going to forget about Ponzi scheme, and I'm going to focus on my secular stagnation equilibrium, because I think it's really important to understand what's going on in this economy. So this is basically a picture that summarizes the situation. So on the horizontal axis, we get output or labor supply. On the vertical axis, we get inflation. And so this is the aggregate demand curve. It's upward sloping. Why? Because we are at the zero lower bound. So at the zero lower bound, when inflation is higher, the real interest rate is lower, and therefore aggregate demand is stronger. So that's the upward sloping aggregate demand curve. Now the aggregate supply curve is just vertical, and labor supply is equal to 1. So it's vertical at 1, up to the point where the downward nominal wage rigidity constraint is binding, which is going to flatten out the aggregate supply curve. And basically, the aggregate supply curve is going to be flat at the inflation rate pi r. Now, you can see there are 2 steady-state equilibrium possibilities. Here you have the neoclassical steady state. Inflation is just high enough for the zero lower bound to be non-binding. And here we have the secular stagnation steady state, jointly characterized by 0 nominal interest rate, low inflation. We should typically think of pi r as being a very low number, maybe 0%. And that's the number for the downward nominal wage rigidity, maybe 0%, maybe 1% at most. But pi r is a low number. So that's low inflation. And we can see that there's a negative output gap. Employment is equal to that level, which is much lower than labor supply. Now, what is the fundamental cause of secular stagnation? Well, there's one friction in this economy, the downward nominal wage rigidity constraint. So let us agree to blame the downward nominal wage rigidity constraint for secular stagnation. But wait a minute. If we relax the downward nominal wage rigidity constraint, if we make pi r smaller, for instance, we just relax the wage rigidity, then in that case, the secular stagnation equilibrium exists, but the economy is even more depressed. If inflation is lower, the real interest rate is higher, there's even less demand, an even more depressed economy. Well, that's the paradox of flexibility. The paradox of flexibility is really the cornerstone of Keynesian economics. It's the idea that a rise in wage flexibility, a lower pi r, reduces output. So what is the fundamental cause of secular stagnation if it's not the downward wage rigidity constraint? Well, the fundamental cause of secular stagnation is the existence of this awkward asset, money. Money is an awkward asset because money yields a 0% nominal return. And that's going to create a pathological equilibrium where the real interest rate is jointly determined by the binding zero lower bound on the nominal interest rate and by the binding downward nominal wage volatility constraint. So instead of the real interest rate being determined by the demand and supply for capital at full employment, instead of this, we have the real interest rate awkwardly determined by this two binding constraints, the binding zero lower bound on nominal interest rate and the binding downward nominal wage volatility constraint. Well, this results in a real interest rate that is excessively high, and that is the fundamental cause of secular stagnation. And therefore, we have this very Keynesian idea that underemployment, the negative output gap, is a general equilibrium phenomenon. It's not due to wages being too high, it's due to the interest rate being excessively high in financial markets, where that depresses demands in the good market. But if there's not enough demand in the good market, then there's not going to be enough demand for labor. And so you end up with underemployment. Okay, so the digression is closed. So I want to go back to my trilemma. So, so the government, so for simplicity, I'm going to assume that the government needs to choose among the three steady-state equilibrium possibilities. In the paper, I also look at the possibility that the government choose an allocation that is away from steady state and let the economy converge to a steady state. But for simplicity, it doesn't really add any new insights. So for simplicity in this presentation, I'm just going to assume that the government needs to choose among the steady state equilibrium possibilities of the economy. Now, the government has essentially two instruments, the inflation target, pi star, that is going to set as low as possible, but consistently with the steady state it's aiming for. And it needs to decide on the magnitude of the Ponzi scheme. Now, there are three steady-state equilibrium possibilities. First is a neoclassical steady state characterized by full employment, no Ponzi scheme, and inflation is a little bit high. If the natural real interest rate is -3, -4%, you may need to have 3 or 4% inflation. You have the secular stagnation steady state, where inflation is very low. If pi r is 0%, that's just zero. You have no Ponzi scheme, but the price to pay for it is that output is depressed. And finally, you have the Ponzi steady state, where you have full employment. You have a Ponzi scheme, which creates a wealth effect, and that's a source of welfare gain. But then there's a cost from inflation. But what's really important is the welfare cost from an upward jump in the price level. So it's probability epsilon. The Ponzi scheme collapses. There's an upward jump in the price level, and that's going to be costly. So the calibration is very stylized. I mean, the model is stylized anyway. So I'm assuming a CRA utility function for consumption, a similar specification for the preference for wealth, where a lower bar is a reference wealth level, just a negative reference wealth level. The calibration is quite standard, nothing really exciting to emphasize. I'm just calibrating the parameters of the economy and of the preferences such that the natural real interest rate is equal to -3%. I'm calibrating the preferences such that the maximum magnitude of the Ponzi scheme is 100% of GDP. I'm also calibrating the parameters such that secular stagnation results in an output gap of 10% of GDP. And I'm also assuming that, well, the reference wealth level here is just 2 years of GDP. The calibration is not very sensitive to that parameter. And that the present value of future taxes is about 100% of GDP. Now, this is a stylized model. This is a stylized calibration. But I think the main qualitative insights that I get from this analysis are pretty robust to plausible changes to this calibration. So what's really important in this analysis is the welfare cost of inflation under a Ponzi scheme. So the welfare cost of inflation is going to have two components. Just a linear component that's just regular inflation, household dislike inflation. But then there's at Poisson rate epsilon, the Ponzi scheme collapses. We have this upward jump in the price level by delta of psi. And that's going to be very costly in terms of welfare. So I'm going to assume a potentially convex welfare cost of a jump in the price level. So first, alpha is the extent to which a jump in the price level is more costly than regular inflation, and beta is the convexity of this cost. Now, why am I assuming that the price level jump is so costly? Well, typically when you have an upward jump in the price level, you have a loss of monetary policy credibility, you have a sudden redistribution of wealth, and you have, you can think of a collapse of a Ponzi scheme as a major financial crisis, a major financial event that is to be avoided. So I look at different cases. The first case I look at is that the case of a linear cost of a jump in the price level. So beta is equal to 1, no convexity, but I'm assuming alpha equal to 5. So that means a jump in the price level is 5 times more costly than just regular inflation. Then I look at the second scenario. where for a small jump in the price level, it's not more costly than just inflation, but the cost of a jump in the price level is very convex. So beta is equal to 6. And finally, I will look at a situation where everything is linear, so a jump in the price level is not more costly than regular inflation. So the main result of the analysis is summarized by this picture. So this picture gives you what is the optimal policy as a function of the two key parameters of the economy. The first key parameter of the economy is psi, the welfare cost of inflation. So the larger is psi, the more household dislike inflation. Psi is this parameter here. And the second parameter is the rate at which the Poisson rate at which the Ponzi scheme collapses. And so the higher epsilon, the more likely a Ponzi scheme is to collapse. And here we're looking at the situation where alpha is equal to 5, so a jump in the price level is much more costly than inflation. Now, if psi is low, that means inflation is not very costly to household in terms of welfare. Or if epsilon is low, which means that a Ponzi scheme is unlikely to collapse, then the optimal policy is to be in the Ponzi steady state, is to have a Ponzi scheme. Now, if the probability of collapse of the Ponzi scheme becomes larger, then at some point, a neoclassical steady state is preferable in order to avoid an upward jump in the price level, which is costly in terms of welfare. We prefer to have permanently higher inflation in the neoclassical steady state. Well, we prefer that, except if the cost of inflation is too large. If the cost of inflation is really large, then the optimal policy is to be in secular stagnation. So the bottom line is that depending on the parameters of the economy, each of these three possibilities could be optimal, resulting in a non-trivial policy trilemma. Now here I'm looking at a situation where the cost of a jump in the price level is very convex. And so we have a slightly different frontier for the region where each of the policies is optimal. And so now the neoclassical steady state is optimal for intermediate value of epsilon. So if epsilon is very low, very, very low, so that a Ponzi scheme does not collapse, then the Ponzi scheme remains optimal. If epsilon is pretty high, then a Ponzi scheme is quite likely to collapse, but endogenously from the equation of the model, it cannot be very large. So the Ponzi scheme is likely to collapse, but it cannot rise to a very large level. So if it does collapse, it's only going to be a small jump in the price level. So it's fine. But what's really bad is intermediate values of epsilon. So epsilon may be 1% or 0.5%. And in that case, the Ponzi scheme the probability of collapse is sufficiently low for the Ponzi scheme to rise to a large magnitude. And so that when it does collapse, it's very costly to have a collapse in the Ponzi scheme. And in that case, the neoclassical steady state is preferred. It's preferred unless, once again, the welfare cost of inflation is so large that secular stagnation turns out to be the optimal policy. Finally, I look at the situation where you have a linear cost of inflation and upward jump in the price level. And in that case, the neoclassical steady state is never the optimal policy. Typically, the Ponzi steady state is optimal unless you really dislike inflation so much that the secular stagnation steady state is preferable. Okay, now I want to take a step back and think about how we can break through the trilemma. How can we overcome the trilemma such as to simultaneously have full employment, low inflation, and no Ponzi scheme? Well, it turns out that there are a number of solutions, none of which is very easy to implement. The first one is to have electronic money, to abolish cash. Now, abolishing cash means that instead of having 3 or 4% inflation, it means that we're going to tax bank deposits at 3 or 4% per year. Not sure that would be very popular. So in theory, electronic money removes the zero bound, so that could solve the problem. I'm not sure that politically it would be very popular. A second possibility is to use tax instruments in order to replicate a negative nominal interest rate. The first possibility is to tax wealth, but this is fraught with wealth measurement issues and liquidity concerns. And the second possibility is to have an increasing path of the consumption tax, such that households have an incentive to front load their consumption, and that would stimulate aggregate demand. But the problem in the secular stagnation is that the consumption tax may have to be increasing forever. Again, that's not very practical. A third possibility that tends to be favored by Keynesian economists is to have government spending. Well, if you have government spending financed by lump sum taxes, you have no Ponzi scheme, and you can have full employment and low inflation. Now, the problem is that from a welfare perspective, government spending is not desirable. If people work more, they get a welfare loss from increasing the labor supply. without getting any gain from, I mean, it would be just a wasteful increase in labor supply because they would not derive utility from the public goods that would be produced by government spending. Now, the goal of having full employment is, well, households are willing to incur the disutility from working in order to enjoy consuming more. And so government spending cannot be the solution. Finally, if we move to a richer model structure, then a possibility to overcome a secular stagnation is to do redistribution from rich household with a low marginal propensity to consume to poor household with a high marginal propensity to consume. Now, the problem with this policy is that a one-shot redistribution of wealth is not going to solve the problem because the poor are going to spend the wealth, and so we're going to get back to square one. Inequality is going to rise again, and we're going back to square one. So if we want to overcome the trilemma with a redistribution policy, it has to be a permanent redistribution policy. But if you did not want to do this redistribution in the first place, then that's a permanent distortion to the allocation of resources in the economy. So again, maybe that could work, but that doesn't seem to be an ideal solution. Okay, now to conclude this paper, I want to take a step back and think about the significance of this framework for the inflation targeting policy of central banks. So central banks are very attached to the 2% inflation target, but if this 2% inflation target is too low, then because the natural real interest rate is below -2%, maybe -3, -4%, so the 2% inflation target is too low, then we have a problem. Why? Because the 2% inflation target rules out the neoclassical steady state. And if we rule out the neoclassical steady state, then we must either be in secular stagnation or in the Ponzi steady state. Well, the problem is that none of these steady state equilibrium possibilities is consistent with inflation being on target. If we're in secular stagnation, then the economy is liquidity trapped, and typically inflation is below target, as it has been in Japan or in the Eurozone for many years. And the central bank cannot do anything about this because the economy is liquidity trapped. And if we have a Ponzi scheme, then inflation can be on target up to the point where the Ponzi scheme collapses, at which point inflation is going to be much above target because we have this upward jump in the price level. And once again, the central bank cannot do anything about this because now this is fiscal inflation and the central bank cannot do anything against fiscal inflation. And so it's kind of nice that within a very simple model structure, we have the two possibilities, the possibility of inflation being excessively low without central banks being able to do anything about it, and the possibility of inflation being at least momentarily excessively high and the central bank not being able to do anything about it. So in both cases, the central bank is powerless. And so I would argue that the trilemma is a fundamental challenge to the inflation targeting framework of central bank with a low inflation target. Thank you very much.